Imagine a world where technology is at a standstill. Picture a reality where your smart devices, electric vehicles, and even the internet are nothing but figments of imagination. Sounds terrifying, doesn't it? This is a world without semiconductors, the tiny chips that power almost every aspect of modern life. Journey into the dynamic universe of semiconductor ETFs, a place where investment opportunities are as diverse and thrilling as the chips that fuel our digital lives. Allow me to be your guide through the complex labyrinth of this captivating financial realm. Here, opportunities are more than just abundant. They also possess the potential to yield substantial rewards. Take a moment to delve deeper into a noteworthy player in this sector, the SMH, otherwise known as the VanEck Vectors Semiconductor ETF. This fund isn't just another name in the ETF game. It diligently traces the progress of the MVIS US-listed Semiconductor 25 Index, a respected in the industry, reflecting not only the market trends but also the innovative advancements within the sector. SMH has built its reputation on a laser-focused approach towards the biggest US-listed companies operating within the semiconductor sector. It offers investors a unique opportunity to gain exposure to the industry's heavyweights and mainstay companies. The ETF envelops the entire array of top-tier semiconductor firms, from Intel, the computing giant known for its microprocessors, and Nvidia, a leader in the GPU market, to Broadcom, a crucial provider for wired and wireless communication, and Texas Instruments, a company with its roots deep within the semiconductor industry. But the SMH is more than just a collection of big names. Let's take a look at its performance history. Over the years, SMH has demonstrated robust growth, mirroring the upward trajectory of the semiconductor sector. It has consistently outperformed many of its peers, reflecting the strong demand for semiconductors in various industries, from consumer electronics to automotive and industrial applications. However, one must always remember that opportunities are often accompanied by risks. In the case of SMH, the potential for high returns also means a higher expense ratio. This is a significant consideration that investors must not overlook as they navigate the intricate waters of semiconductor ETFs. After all, successful investing hinges on well-informed decisions. So, ponder your options, conduct thorough research, and plunge into the investment world only when you're fully equipped. Investing isn't about instant gratification or quick profits. It's about fostering long-term growth and stability. However, remember that with the potential for high returns comes a higher expense ratio, a factor worth considering before diving into the world of semiconductor ETFs. Delving deeper, SOXX, which tracks the ICE Semiconductor Index, unfurls a panoramic view of the market dynamics. This exchange-traded fund, ETF, tirelessly explores the vast expanses of the continually developing semiconductor industry, both within the United States and across international borders. The geographical diversity of this ETF is a vital component in enriching an investor's portfolio, given the diverse and global nature of the companies it encompasses. The index incorporates a diverse range of companies, both established giants and burgeoning startups, that are spearheading innovation in revolutionary technologies that are shaping our world. Ranging from firms that specialize in microprocessors, powering our everyday technology, to businesses pioneering memory chips capable of storing colossal amounts of data, SOXX incorporates them all. This extensive coverage is beneficial for investors seeking a single investment vehicle offering exposure to a broad cross-section of the semiconductor space. Performance-wise, SOXX has consistently delivered strong returns, a testament to its prudent stock selection and effective diversification strategy. Historical analysis reveals a strong track record of growth, underlining its credibility as a choice investment for those who wish to ride on the semiconductor wave. Furthermore, this ETF offers a unique blend of holdings across domestic and international corporations. This mix provides a more comprehensive and global perspective on the sector, something that could potentially be missed when investing in a more localized portfolio. The appeal of such a diverse ETF is undeniable, but it does bring along its own set of risks. These include susceptibility to international market fluctuations, often due to geopolitical uncertainties, shifts in economic indicators, and changes in regulatory policies. Additionally, the ETF's holdings across various currencies can lead to potential volatility due to exchange rate fluctuations. While this diversity presents opportunities for growth, it also introduces a layer of risk due to exposure to international markets and currency variations. Thus, SOXX provides a comprehensive view of the market, offering a balanced mix of risk and return, making it an attractive option for seasoned investors. Diving deeper into the XSD, which is an equal-weighted index, we see that it embraces an approach that stands distinctively apart from traditional indexes. This index is designed to provide a balanced exposure to the semiconductor industry. The underpinning principle here is that unlike traditional market cap-weighted indexes, the XSD assigns the same value to each company it represents. The result is an egalitarian representation that doesn't prioritize one company over another. This equal-weighted methodology breaks the mold, offering all participating companies, regardless of their size or market influence, an equal opportunity to demonstrate their performance. This is a stark contrast to the market cap-weighted indexes, where larger companies often overshadow their smaller counterparts due to their immense size and influence. Now let's delve into the XSD's performance history. Despite being a lesser-known index, XSD has been a consistently strong performer. It offers a platform where every participant, from industry behemoths to nascent startups, gets a fair shot. The success of a company on this platform is based purely on its performance, not its size or market presence. However, the XSD's equal-weighted index approach is not without its downsides. While it does create opportunities for lesser-known companies to shine and potentially become hidden gems, it also means a lack of focus on the industry leaders. Therefore, while the potential for uncovering undiscovered talent is high, it also means there might be a slight miss on the steady performers, traditionally the larger, leading companies. Overall, the XSD's uniquely democratic approach provides a balanced exposure to the semiconductor industry. It ensures that each company, regardless of its size, is given equal significance, fostering an environment of healthy competition and performance-based growth. FTXL, PSI, and SOXQ are unique entrants in the world of semiconductor ETFs. They might not be household names in the investment community, but they each offer distinct strategies that are worth considering. Let's delve into these ETFs in more detail. Firstly, FTXL has carved a niche for itself by focusing on technology innovators. This ETF is carefully curated, featuring companies that are spearheading technological advancements and breakthroughs. Its past performance shows a consistent growth trajectory, having benefited greatly from the tech boom. The potential advantage of FTXL lies in its focus on innovation, which could translate to higher returns. The drawback, however, is that it may be susceptible to the volatility of the technology sector. Next, PSI stands out with its focus on overall liquidity and price momentum. It targets companies with a solid financial standing and an upward price trajectory, which means it a track record of investing in firms that are financially stable and growing. However, it's worth noting that while its focus on momentum can lead to significant gains in bullish markets, it could also result in larger losses during downturns. Lastly, there's SOQQ ETF. This fund takes a different approach altogether, with a design built to deliver leveraged daily returns. This aggressive strategy could appeal to more risk-tolerant investors. Its past performance has shown it capable of delivering high returns, but it also comes with a higher expense ratio and increased risk, making it a less suitable choice for conservative investors. In conclusion, FTXL, PSI, and SOXQ each offer unique angles to investing in semiconductor. However, like all investments, they come with their own sets of advantages and drawbacks, and potential investors should carefully consider these before deciding which one is the best fit for their portfolio. To summarize, investing in semiconductor ETFs presents a fascinating opportunity to profit from a sector that is at the heart of technological advancement. From SMH's focus on industry leaders to XSD's balanced exposure and SOXX's broader market view, each ETF offers a unique angle to investing in this crucial sector. However, each comes with its own set of risks, from higher expense ratios to market volatility and international exposure. Remember, the best investment strategy is one that aligns with your personal financial goals and risk tolerance. So take a moment to ponder, analyze, and choose wisely. After all, in the world of investing, knowledge is not just power, it's profit. Before you go, remember to hit that like button if you found this information valuable. And don't forget to subscribe for more insightful content on investing. Here's to making smart investment choices and powering the future of technology.